Well, welcome everybody. Welcome to this Gilligan Rowe webinar on the tax changes that have occurred and are scheduled to kick in from March the 27th of this month in 2021. Certainly, this is one of the most tumultuous times in property that I've experienced. I've been in property for 25 years, and shock and awe I think the property community is feeling from these changes. As I was saying a few minutes ago, I think it's fashionable to paint property investors and landlords as greedy oligarchs these days, and certainly the narrative of this government has become increasingly aggressive, with talk of tax loopholes that property speculators are enjoying, which are, of course, mainstream deductions that are generally accepted accounting practice. It's been quite revolting to see the increasing escalation of the narrative against property investors, and to sit there and watch the government spin what they're doing, which can only be described as an attack on middle New Zealand and property investors. I think property investors have one thing in common, and that is that they provide for themselves to get ahead. And we have possibly the most popular government I've ever seen. And every single Kiwi can't stand the thought of hungry kids or hungry families. And we've all wanted to feel safe in a pandemic, and this government has certainly made us do that. Everybody supports a government initiative that feeds kids and keeps us safe, and that has been very much the thrust of this government's public profile. But what I think we don't support as a community is a government that holds enterprise back, or that tries to hold a community down, or to try and make us all the same, for that matter. And I think that's very much where the narrative and the thrust of this government is going. I don't like it at all. The dialogue shifting from providing for yourself to having the government provide it for you, and they are increasingly interfering in the private sector. We've all noticed the antagonism, and I think people are getting tired of it. You have to say the complete mismanagement of KiwiBuild, and how somehow that's been made to look like it's landlord's fault. If they'd achieved 100,000 houses or done something about the housing market, we wouldn't have the supply issue we have. The RMA is only just starting to change. We need to push our zoning, the Auckland zoning, right across the country. We don't have a land supply problem or a housing supply problem, we have a zoning problem. If you take high density zones through the rest of the country, you will rapidly see supply increase, but it's very constrained. I have land in Rowe that I can build 2 houses on. In Auckland, on the same amount of land, I can put 7 or 8 houses on it, terraced houses. So they need to do something about the RMA. We are finally getting the bubble being discussed, aren't we? And I think that this government manages its policy by what it sees in the media, how it's been beaten up. The media has been banging the drums of opening the bubble, and hey presto, we will have an announcement in 2 weeks. This stuff's been coming for 15 months. You'd think that stuff would be advanced. The media has been banging the drums of taxing rich property investors who are getting away with tax incentives and tax-free capital gains. And hey presto, we have turned away from an election promise, an ironclad election promise from Grant Robertson, not to touch taxes, to not extend Brightline rules, to not introduce a capital gains tax, to not introduce new tax regimes. Bull-faced lie. He has introduced a 10-year extension to Brightline rules and introduced one of the most far-reaching measures in the New Zealand tax system for property investors, and that is the denial of interest deductions. And so all this stuff hangs together. It's a government that is, I consider to be anti-enterprise, that's trying to interfere in our households, and it's extremely disappointing. But for most investors, I think that these changes actually don't represent an insurmountable hurdle. The speculators are already paying tax. It's business as usual. They continue to get tax deductions, don't they? And now if you hold on to your property for 10 years, well, you get out of Brightline rules. So that's not going to kill you. These interest deductibility rules, these are a serious issue. So we're going to talk a lot about that tonight. It depends on how much gearing you're carrying as to how badly you get bitten by those rules. But certainly if you are carrying a lot of leverage, I think that there's some serious implications for private households. So I want to talk more about that. So that's my diatribe at the beginning. I'm going to give you another one at the end, but that's my opening diatribe. Let's now just have a quick introduction. GRA are property accountants based in Newmarket, and I'm the MD of GRA. My name's Matthew Gilligan. We are all investors in GRA. Most of the staff invest. I'm an investor. I'm a developer. I develop to hold. I've developed to sell. I trade property, and I have a buy and hold portfolio. Some 60 houses in my buy and hold portfolio at the moment. A lot of them JVs with some of my colleagues here, particularly Celeste Chand at the office. I own 30 houses with him. So GRA are specialist advisors in property. We do a lot of trust and tax planning, specialist tax advice surrounding business and property. We do a lot of asset protection structures, insolvency advice, and we advise on property investment an awful lot because it's an expertise of practice, including property development and property costings and so forth. We also have a trustee services division. For frontline team members, myself as managing partner, I work in the tax and property team with Anthony Lipscombe, who's with me here tonight. Anthony is a lawyer and chartered accountant and very accomplished tax practitioner, been with GRA some 17 years now. John and Celeste run the accounting practice, doing the more traditional accounting functions, GST and tax returns and so forth. And while they themselves don't do them, they have a team, probably, I'm going to say 80 in the team under those two in the practice. So about 100 staff at GRA. We're a medium-sized firm, and we certainly do have a broad skill base. Our agenda this evening, tax changes. We're going to go through the new law and the uncertainties that the law is creating. We're going to use examples and issues. I see we have 91 questions. I would suggest that we will answer nearly all of those questions using our examples and issues. I'd certainly hope we'd get through the bulk of those questions. Many of you have been kind enough to email Anthony and I your questions in advance, so that's how we've created those examples and issues. I'm then going to talk about market implications and look at critical thinking for what I think investors should be doing in this environment, which has certainly turned upside down. So let's get straight into it. And forgive me for going through the basics, but we've got people all over the world online tonight. They've been emailing me, and a lot of them are not up to speed, so we need to go through the basics. So the first and perhaps most major change in rules is the residential interest deductibility rules changing. There are no interest deductions for second-hand houses from the 1st of October 2021. So how are these rules going to operate? Well, new builds, of course, have been given an exemption. They will maintain interest deductions. So that's the first point. So these rules mainly affect second-hand property. So second-hand property acquired on or after the 27th of March is going to get no tax deductions for interest come 1 October 2021. So second-hand properties acquired prior to the 27th of March will get phased out interest deductions over the next 4 years. So phased out, meaning effectively they're removing them 25% per annum, cycling down from 100% deductible to 75, 50, 25, 0% deductible over the next 4 years. So that means that from 1 April 2025, there will be no ability to claim interest as a deductible expense on second-hand residential properties in New Zealand. So here is the IRD's grid for the phase-out period. You can see up to next week, March 2021, all interest is deductible on all property in New Zealand, all investment property. And then from 1 April, these residential restrictions start to apply. So up until September, everything's deductible. From 1 October, it's 75% deductible. So that effectively means for the next financial year, we'll get 87.5% deductibility. For the following year, it drops to 75, 50, 25, right down to 1 April 2025, it kicks in at 0% deductibility. So this is obviously a terrible shock to most investors. Let's look at a worked example of how this is going to roll out. So this is an investor with a $750,000 property, earning $650 a week rent per week. And they've got operating expenses, rates, insurance, repairs and maintenance of $5,800, reading down the green column. Net yield of $28,000, take off the interest of 3% on $750,000, that's $22,500. So they've got net cash flow of $5,500. So in the current financial year, normal tax applies. They pay tax of $1,800 on the 5,500, and they're getting 100% deduction on that interest. So their net cash flow is $3,600 positive. So there's the happy world we live in at the moment that this government is wanting to disrupt. So we then move to the next financial year, and down the bottom there, if you look at taxes, everything else is the same. Taxes move up by $900, which is because we lose 12.5% of the interest as non-deductible. So phased out interest deductibility, we get 87% interest deduction. So the net cash flow is impaired by the lost interest deduction, the tax on that, which is $928. So you roll that forwards the following year, 50%, 75% deductible, following year 50, and you end up with, in 2026 financial years, you end up with all of the interest non-deductible, $22,500. If you multiply that by a tax rate of 33%, then that's $7,425 of lost deduction. Lost tax you need to pay because you've lost the deduction on the interest. So you look at that, the investor this year is plus $3,600. In the 2026 financial year, they are negative $3,740, the difference being the tax they've had to pay on interest they can't deduct. Okay, so you look at that investor and you might say, well, most households should be able to cope with $7,500 of negative cash flow. It's an effective increase in interest rate of a third of the interest they're paying. And I think most households will be able to pay that. It's not right, I think, that they are having to pay it, but I think most households are going to be able to pay that. So if that's your circumstance, I imagine your household is still stable. And the positive we can take out of this is it's coming in over 4 years. There's no need to panic. It's only 12.5% effective. It's only $1,000 next year, going to $2,000, $3,000, gearing up as the rules are phased in. So that's not necessarily going to destabilize the entire economy. So no need to panic. There is in the wind discussion from the Reserve Bank and the government surrounding taking away interest-only loans for investors. So if you bring that into the equation, it would be about $18,000 a year if you're forced to pay that debt down. So suddenly it gets a bit more serious. This is something to watch for if the Reserve Bank pushes for this or the government pushes for this. So, negative, positive cash flow of $3,600 in the current year would be minus $14,000 if you were pushed onto principal interest. And this is over 25 years. So year 5, you would end up being minus 21 grand. So if you start to get these initiatives being pushed in together, then you'll see some insolvency in the market. But at the moment, I don't see insolvency because everybody can cope with that amount of cash flow from the interest deduction reductions if you've got a sensible amount of debt in your household. So Brightline extension to 10 years. This is obviously a complete reversal of the election promise. Grant Robertson talking to Heather Duplessis-Allen, saying unequivocally he will not do this, and he's turned around and done it. Of course, everything is the fault of COVID. Because of COVID, we've had to do this because of the change of circumstances in the country, caused by the Reserve Bank and Labor allowing LVRs to go to 80%. And if you look at it, we're at the back end of property boom that is completely dying at the moment. Every real estate agent that I know is saying that stuff's starting to sit round. There's a last flush of activity for people buying before March the 27th to avoid these rules, but the investment stock is starting to sit. And so the feedback is the property market was booming. Was cooling. I was talking to Tony Alexander this afternoon, and he said that the data right up to February was showing it cooling. There's been a flush in February, but he sees the market as cooling too. And that's everybody anticipating the 60% rules coming in and LVRs, and the banks arresting the market. So nevertheless, we have on the tail end of this, the government saying that we are in a full-blown property boom. We have some bankers saying that the LVR rules moving to 60% will not change anything, which I completely disagree with. I mean, those guys were obviously not around in 2016 when LVRs went to 60%, and it just crashed the market. So anyway, that's all been ignored. And to cool the property market, to solve the problem, I don't see the problem, but to solve the problem, we now have Brightline extension to 10 years. So the current Brightline period is obviously 5 years. Properties acquired on or after the 27th of March will be subject to the 10-year rules. And again, there is an exception for new builds. They continue to be subject to the five-year period. So there's not a lot of detail on what a new build is. Okay, new builds have been given the special treatment. You are not subject to the interest deduction phase out, and you are not subject to these Brightline rules, obviously with a focus on increasing supply. So the suggestion is that it's going to include properties that were acquired within a year of the Code of Compliance certificate being issued for the property. So presumably real estate agents are now going to have to attach a copy of the Code of Compliance certificate, because it's going to be critical for investors to gain these exemptions. So in regard to new build queries, will all the exemptions apply to an existing rental that was previously bought new? We don't know. We're waiting for the consultation with the government, but as existing rentals that were previously bought new, that is a question mark. Does it meet the definition of new supply? If it's got a Code of Compliance certificate within 12 months, possibly, but we don't know. We're waiting for consultation. Will it apply to rental properties built by an investor themselves on existing land? Developed to hold, for example. Developed to hold is your purpose. Well, it's likely months before we get the answer to these things. I would certainly hope that that would count as new supply. You've got a Code of Compliance certificate within 12 months. You've made the property. I would imagine that it would be the intention to exempt that, but we'll have to wait and see from the government. So consultation in coming months will be critical around this sort of stuff. The home exemption change is from the Brightline rules is another change that we need to be cognizant of. So this is a change to the main home exemption under Brightline. Previously, you got an exemption if you lived in the home for most of the time that you owned the property, which was deemed to be more than 50%. So by example, if you buy a property in 2022 and rent it for 1 year and live in it for 2 years, and then you sell it under the current rule, the gain would be exempt Brightlines because you've lived in it for more than 50% of the time. So this has changed. Under the new rules, the full exemption is only payable if you live in the property 100% of the time. So what they have done is bring in a de minimis rule, which gives you a pro rata taxing on the mixed use. So for example, if you lived in a property 1/3 of the time, then they would say 2/3 of the time it was a second property available for other use, and therefore 2/3 of the property is available for an alternative use other than home ownership. So 2/3 of the gain will be taxable. So that's a change. Now, in all of this, I think absolutely critical is the date of acquisition. It's critical for determining whether you've got 5 or 10-year rules applying, and it's critical for determining if phased out interest deductions are going to apply to you, or whether you have no interest deductions from 1 October. So acquisition occurs when there is a binding sale and purchase agreement in place. That's your deemed date of acquisition. So if agreement is dated prior to the 27th of March, then you're going to have 5-year Brightline rules and phased out interest deductions. So you'll get to enjoy the benefit of the last gasp of interest deductibility. If you've got a sale and purchase agreement dated on or after the 27th of March, that's this Saturday, then you've got 10-year Brightline rules, and you've got no interest deductions whatsoever from 1 October unless it's a new build and it meets the definition of a new build. So, of course, new builds get full interest deductions, just like existing properties, business as usual, and 5-year Brightline rules for new builds. So that, to me, that's an astonishing advantage to distinguish between a property that's 12 months old and a property that's 13 months old, and give one a lifetime of interest deductibility, business as usual, and the other, zero interest deduction. It seems like a crazy distinction to me, and a massive incentive for supply. Given the government has completely gone back on their word, extended Brightline, and brought in this new interest deduction limitation, you have to question anything they say about tax. They're giving us this new build exemption. Just like people have piled in and bought property in the last couple of years and are heavily indebted, and now they can't claim their interest deductions, will the government then remove this new build exemption in coming years? Certainly wouldn't surprise me to see that sort of thing. An immediate action point for people in relation to the date of acquisition is, if you are currently going through a restructure with your professional, then you need to do something about this literally tomorrow. So if you're considering moving a property, then you need to have a binding agreement in place to sell it and buy it between your related entities. For example, you to an LTC or you to a trust. If you don't have a binding agreement in place tomorrow, then you'll lose the 5-year Brightline rule. You'll be into the 10-year Brightline rule, because related party restructures still put you back, reset the clock for Brightline rules. So if you don't do it tomorrow, then you'll have 10-year Brightline rules. If you do it tomorrow, you'll have 5-year Brightline rules. And if you restructure after tomorrow, you will literally lose the benefit of the 4-year phased out interest deductions. So you sign that sale and purchase agreement on Saturday, you lose your interest deductions from 1 October 2021. So that is a critical thing to be aware of, and accountants are, getting hundreds of calls by the hour at the moment. GRAR, our phone's gone berserk. So that is the consequence of a government that doesn't consult with the community. You end up having stuff slammed through so that you can't finish your business in an orderly manner and take professional advice. So if I sound scathing, I am scathing with what has happened. I think most of the tax community are. No consultation, rules jammed in at no notice, and it's an attack on middle New Zealand. So after tomorrow, you've got 10-year Brightline rules and no interest deductions.
Yeah, I might just jump in. I think you've made this point very well, so it may be unnecessary for me to say, but It's only the sale and purchase agreement needs to be done by tomorrow.
Yeah.
I think you've made the point, but just to be absolutely clear, you don't have to have settled and transferred and changed the title if you're going through a restructure. It's a signed sale and purchase agreement.
Yeah, excellent point. Thank you, Anthony. That's spot on. So just get that sale and purchase agreement in place and you can sort out the banking and the finance and everything later on. Now, I know we've got a few lawyers and accountants online tonight, and here's a thing for you to be aware of. There's a potential trap with nomination because it's not unusual to sign it up and Matthew Gilligan will nominee and then nominate the trust later. So if I, for example, have signed a contract on the 1st of March this month, and then I nominate a trust on the 1st of April, actually, when you nominate, you have a deemed reacquisition date, and it becomes the later date that you nominate. So despite having a binding agreement on the 1st of March, if I sign a nomination agreement on the 1st of April, which typically happens, you turn up to your lawyer's office and you sign your conveyancing documents and your banking documents, and then they present you with the nomination document and innocently sign it on the 1st of April, the day you're settling, and hey presto, you've now got an acquisition date after March the 27th, so you lose all interest deductibility phased in over 4 years, and you're on 10-year Brightline rules. So this is an important point for investors to be aware of and professionals. Make sure you ask your accountants and lawyers about it. You should be signing your nomination agreements by tomorrow. Anthony, chip in if you need to. So if you have a property in contract and you intend to nominate, do it now and have it done by tomorrow, please. That's so important. Right, so that is actually the bulk of the tax law covered off. We're now going to go through some Q&A and try and cover off some of these questions. And the first one is for secondhand property. Let's say an investor purchases a secondhand property. They've signed a sale and purchase agreement on the 1st of March and they settle on the 1st of April. What interest deductions are available? Well, they've got a binding agreement before March the 27th. So they get 4-year phased out deductions in the next 4 financial years, but they will need the binding agreement to be in place. So that means if they're nominating, they have to sign their nomination agreement by tomorrow. What Brightline period do they face? Same answer. They're prior to the 27th of March. So 5-year Brightline rules, as long as you've got your binding agreement in place. And in this case, they have those conditions are satisfied, so they benefit from the exemptions. The next example is an off the plans purchase, and so many questions on this. This should answer a whole bunch of the 151 questions we've got there now. So you sign an apartment off the plans. You signed an agreement on the 30th of June 2020, settling after 27th of March 2021, later this year or next year. What interest deductions are available and what is the Brightline period? So it's the same as the previous example. You get 4-year phased out interest deductions and 5-year Brightline rules because you have a binding agreement prior to the 27th of March. So you're good to go. However, it's worth noting that you may qualify for the new build exemption. And as we don't know the definition of a new build, we can't say with certainty that it would apply, but it would seem to apply because on the indicative discussion documents we've seen, if you buy a property within 12 months of CCC being issued, then it's counted as a new build. So we'll be watching for the definition of new builds, but if this property meets that definition, which it could very well do, then it would be exempt these rules, and you'd be 5-year Brightline and no 4-year phase-in. So I hope that makes sense. We're waiting to see if it's going to be a new build. You're definitely going to get the 4-year phase out, and you most probably will get the benefit of the new build exemption and be able to claim interest forever until the government change their mind. So you purchase a 13-month-old house. This is the next example. It's May 2021 when you buy it. So this is just the new rules in action. You settle June 2021. What are your interest deductions available, and what is your Brightline period? So we've got a property that has a code of compliance that is more than 12 months old. So we have a second-hand house. It's acquired after March the 27th. So the new rules are in action and we settle. So likely not a new build, no exemptions available, 10-year Brightline period, and from 1 October, interest deductions are denied, so you are being taxed on your net yield, rent minus operating expenses, rates, insurance, repairs and maintenance. So you get the full whack of these new rules on you. So obviously that is going to create a huge slant towards new housing, and that will be in hot demand. Another example, you purchase a new terraced house in November 2021 and you settle in December 2021. So now we have a terraced house example. What are the interest deductions available? What is the Brightline period? Okay, so it's post March 27. We have a binding agreement after that period, but we have new property. The code of compliance has been issued within 12 months of acquiring the asset. It's a new property. So most likely, 5-year Brightline period, and we get normal historical interest deductions. It's business as usual. So from the plethora of examples we've had emailed to us, that should cover most of them. One more that is more contentious and can't be answered, but we can give an indicative answer. And that is where you own existing land and you develop it and hold on to the resulting new property. So you purchase land, let's say you build 10 terraced houses on it, on or after April 2021, and the tenants move in, 15 months later when you finish the build. So this is developed to hold, and the question is, what interest deductions do you get, and what is the Brightline period? So it's new stock, code of compliance within 12 months if they continue with that definition. So the likely answer is you'll get 5-year Brightline and normal historical interest deductions. Anthony, pretty sure I'm right to say that the Brightline period runs from the historic date of acquisition. So this is, you've purchased the land new in April, so it'd be 5 years from the purchase date. But if you'd owned that land for 10 years, then you would be exempt Brightline already, wouldn't you?
Yeah, correct. So your Brightline is not influenced by subdivision or building. I often say that the Brightline period hinges on the day that you settle the purchase of the dirt. And
yeah, just come close to your mic because you're hard to hear. Yep.
Yeah. The Brightline runs from the day that you settle the purchase of the dirt.
Okay. From the date of purchase.
Not influenced by subdivision, new titles, new building. The day that you settle the purchase of the dirt, that's the day that the clock starts running.
Okay. Disappointing that your microphone is not working, but I think we got most of that. And Anthony has said that the Brightline rules, a date of acquisition is not influenced by subdivision, issuance of title, whether it's a unit title or fee simple title, all irrelevant. The date of acquisition is the binding contract. So this is interesting to consider your effective tax rate with the combined influence of Brightline and interest deduction denial. So let's look here. John's trust owns a property and it's owned it for 9 years. And we'll say that it's acquired after March 27. So this is a property that is affected by the new rules. The cost is $500,000 and John sells it for $900,000 9 years later. The interest not claimed on this property over that period, the non-deductible interest is 9 years at $15,000 a year. So that's $135,000 of interest that John can't claim. So that means that over that period, he's going to pay $45,000 of tax on that interest. So the question is, from a Brightline perspective, can you claim the interest that you haven't deducted against the Brightline obligation? Because you've got $400,000 of Brightline income that's taxable, which is 133,000 of tax. Or alternatively, if the government let you deduct the interest that you haven't been allowed to deduct, then it would be 265,000 taxable, which is 87,000. So is it 133,000 or is it 87,000? Let's assume the asset's cash flow neutral and apply the new rules. If you're paying tax on 130, if you've not been able to deduct the 135,000, then you've paid 45 grand of tax. And then you've either had to pay Brightline tax of 133,000 or 87,000. We don't know yet because the government hasn't clarified whether you can offset this interest that you haven't been allowed to deduct, the interest carried forward that's non-deducted. So it's either going to be 133,000 or 87,000. We're waiting to see. So you're going to have a total capital tax of either 44%, 178,000, or 33%, 133,000. So of the gain of 400,000. So that is effectively the capital gains tax regime that we're going to be facing through the back door, because Brightline rules are a capital gains tax, and denial of interest deductions is a backdoor tax on capital. And I'll tell you what, if we don't get to deduct the interest not deducted, you're getting double taxed. So, this will be very, very expensive if the government are not kind to us here. So, with all of that in mind, I guess you guys want to know what you can do about it. And pretty hard to say when we don't have the rules clarified, but there are some thoughts we've got. So I think we should go through and look at some of those thoughts and then have a crack at some of the questions, and then I'll probably talk about market conditions and then answer some more questions. So we'll carry on with that format. So if you're in a situation where you really want to look at repurposing or recharacterizing your portfolio so that you can take advantage of the exemptions, the first and obvious idea that comes to mind is boarding house. A boarding house is an ordinary residential property zoned for residential use, but it has 6 or more bedrooms. And if you rent it by the room, then it becomes deemed commercial for tax purposes, which historically has taken it out of Brightline, and therefore could potentially be a solution to take it out of these interest deduction rules and Brightline rules. So that is one opportunity for you to consider. You'd have to have a house with 6 bedrooms or more. You could build some more bedrooms on the house to get to 6, or build 2 houses and operate them together communally as a boarding house, servicing one as a bedroom space and the other as a kitchen space. So you can think outside the square, but boarding houses are a potential solution to this problem. Of course, trading and developing has been specifically labelled as exempt from these rules. We know that traders and developers already pay tax, so of course they're going to be exempt. Brightline, they're taxed under ordinary income tax rules, but they are also exempt from interest deduction rules. So maybe you guys just spend a bit more time trading and developing because these activities exempt you from the effect of these interest deduction rules. Of course, you can sell your residential and buy commercial property, which is exempt these rules, or re-employ your capital and your ability to leverage into new builds. And I think everybody's going to be thinking about doing that. Certainly I've already started thinking about that. And it could be that if you've got developable property and you've got the financial capacity to do it, then you could enter the develop to hold business and start buying property to either buying property to develop to hold, or building on existing property, because it is more than likely that will meet the definition of new build and therefore be exempt. So obviously can't hold us to that because they haven't clarified the rules, but that's what we're expecting. And what a ridiculous thing that it is that we have to jump through these hoops, and suddenly second-hand houses are brandished toxic from a tax perspective. Investors start selling them off. They're no longer providing them as accommodation to the rental market. It's going to shrink supply for existing second-hand houses because of the tax disincentive. And so that's tough on renters, it could push rents up, and it's tough on landlords because you're suffering the cost and the hassle of re-employing your capital. Another opportunity, which I think is pretty mainstream, and most brokers and accountants, I see them doing this sort of thing, is repurposing debt. And this looks back to the interest tracing rules that used to be utilised some 25 years ago before the government changed the rules surrounding interest deductibility. So it used to be that you had to trace every loan you had to a business asset or an investment asset to get a deduction for it. And so those tracing rules are still around, it's just they will become more relevant now. So I'll give you an example of interest repurposing over a commercial asset. So let's say Brendan sold his commercial property to a trust, and the trust owes Brendan $1 million from the sale of that commercial property to the trust. It hasn't been gifted. And he also has a residential property or a property portfolio with $1 million worth of debt on it. So now you have 3% of non-deductible interest, which will be a cost to Brendan. He's going to pay tax on 33% of $30,000, which is $10,000 of tax on the non-deductible interest. So what Brendan can do is have his trust borrow the $1 million to repay Brendan. That's an outstanding loan balance to Brendan. The trust can refinance that loan balance, pay Brendan back the money. The residential property is left where it is, so you don't trigger Brightline, just leave it in the same entity. And now you've paid off the non-deductible residential debt. I can't believe I'm saying this. Non-deductible residential debt. You paid it down to zero, and now all debt is deductible. I can't believe I'm saying this because it's such a paradigm shift. You know, it's incredible. So I hope everybody understands that. And so, what if at this point I've heard lawyers and other tax practitioners look at arrangements like this, and they haven't thought of it before, and so they think, oh goodness, this is tax avoidance. And indeed, we dug it out, Anthony dug it out a few minutes ago. I don't know if you put it on my desk. What's the tax information bulletin, Anthony? You've got a statutory reference here, or reference?
Yeah, let's say it's a questions we've been asked, actually, Matthew. So the IRD from time to time issue what are known as questions we've been asked. And back in 2012, the 11th questions we've been asked statement that they issued that year, so QB 12/11, for anyone who really feels compelled to look it up, QB 12/11, that talks about an arrangement where a property is sold into an LTC and money borrowed by the LTC to buy the property from the shareholder of the LTC, and the IRD express a view that such a rearrangement of one's affairs, whereby the LTC borrows money, the shareholder gets the money, and in this instance uses it for a private purpose to buy a home.
Yep.
They express a view that that's not tax avoidance. Okay,
so unfortunately, Anthony's hard to hear, so I'll repeat what he said. So the question they were answering was, can a taxpayer with a family home who's going to repurpose it for an investment purpose transfer that property to a look-through company? The look-through company then borrows the value of that family home, pays it back to the shareholder. The shareholder then uses those funds to buy a new family home. Is that a tax avoidance arrangement? And most firms in the country thought most certainly not. And indeed the IRD agreed that it isn't. But it was used to astonish and somewhat annoy me that tax practitioners, some of them rather conservative, would view such an arrangement as an avoidance arrangement. But it is a useful bit of guidance from the IRD, because they recognise that you are allowed to move your assets around and repurpose interest as you move the assets around, which is what that tax information bulletin is talking about. So another example of this is a business asset. Maria has a business earning $350,000 per year plus her salary, and she has a residential property or property portfolio with $1 million of debt on it. There is 3% of non-deductible interest on that now, so that's 30 grand, 10 grand a year of non-deductible interest, and so the total debt on the residential property is $1 million. And sorry, it's Mana, isn't it? So Mana then sells the shares in the public and private stocks to a trust, and the market value of them is 500,000. So he sells the shares to the trust for 500,000. I think I just jumped a thing, didn't I? Yeah, that's no good. My slides are actually not allowing me to delete that. So I'll just tell you the answer of this. So I just jumped the slide. So Maria's got a business. It's earning 350 grand a year. She could value that business, sell it to a trust, and let's say the value of the business was $1 million. The trust will now owe her $1 million. So the trust could then borrow $1 million and pay that back to Maria, and then she pays down the debt on the residential property. So that is repurposing debt for the purposes of a business asset. Now, this example here is Mana. Mana's got $500,000 worth of shares and residential property with $500,000 of debt on it. Same example, Mana can sell the shares in the publicly listed stocks to a trust. The trust can borrow money to buy the shares, pay it back to Mana. Mana then pays down the debt on the residential portfolio and has repurposed the debt. So these are tracing rules and interest repurposing. Not everybody can do this. The circumstances have to fit, and this is something you take advice of your tax advisor on. So those are some ideas for you on, some tax planning ideas for you. Everything is so preliminary. The rules have been out a few days. There is going to be a public consultation. We're still waiting for the market to give us, for the government to consult with the tax community. It's extraordinary. Normally, a significant change in tax would have years of consultation with Treasury and with the public through IRD. And this has been whacked through with no consultation. It's extraordinary. And I think there's going to be some quite adverse consequences, unanticipated consequences. I think at this point, so you can tell that I'm a little bit annoyed. Like I always tried to be impartial and stand back, be a little bit independent in the way I look at things and look at both sides of it. But I'm really quite shocked with what's happened, and I'm very annoyed. And you'll see that my presentation on market implications and this government are showing a bit of frustration that this government's not been kind to us at all. And I think that means we have to show our dissent for what they're doing. This government seems to only respect pushback through the media and pushback through the polls. So we've got to stand up as a community of property investors and let this government know that we're going to vote and we're going to punish them for what they've done. And if we don't do that, if we sit as an apathetic group, they'll walk straight across the top of us, and this will get worse and worse. So actually, I'll tell you what, if you don't mind, I'll finish the presentation and we'll do the quick Q&A at the end, because that's going to go for quite a while. So, okay, someone's got to pay, right on cue, someone's got to pay for all the hugs and handouts that are going on. We've had the 39% tax bracket introduced for income above 180 grand. That comes in next year. We've had capital taxes this week foisted upon investors, CGT and stealth through the Brightline rules. About $600 million worth of tax is a common estimate around the traps. This is from interest deductions denied, which are estimated to be $1.8 billion worth of interest being paid on residential property in the country. So 600 million is, a rough estimate of what our community is expected to pay as a contribution to what the government are wanting to fund. I think this is envy politics, in this regard, property investors are easy targets. Every week in the Herald, I see property investors bank on average $300,000 from sale of capital assets, or they will highlight a property that has been sold for some great big gain. They don't look at the 10 or 20 years the property's been owned, or the huge amount of work that's been done to the property at great cost, because the person is a trader. They don't highlight that the person trading the property, if it is a short-term thing, is already paying GST, income tax, is employing lots of people, is revitalising an asset that was run down, or redeveloping an asset, increasing supply. None of this is highlighted. Just envy politics, and the media is the agent of the government in this regard. They are just beating us to death with this stuff. So I say to you guys, remember this debacle in 2023, please, when you vote. I'd like to be an independent professional, but I'm super annoyed by what this government's doing. We have to punish them. The interest loophole for speculators that we have been mining, apparently. Interest is a tax deduction that is treated as a tax deduction globally for businesses and property investors. Under generally accepted accounting principles, it is an expense, a legitimate expense. It's been a legitimate tax expense in New Zealand for over 100 years. So to call it a tax loophole for property speculators is distasteful PR from this government at best. It disgusts me. But it just is in the narrative of how they're communicating about property people and property investors. There's some unanticipated consequences of all of this. One of them is, I shouldn't say some, many unanticipated consequences. One of them is, and perhaps one of the most serious, I think, is the debt servicing implications and how banks are going to look at your servicing moving forwards. Well, if you look at the background of these rules, they came from the UK and they're pretty much a copy and paste. And the UK doesn't have a debt servicing test. If you've got a deposit, they'll lend to you. They do have DTIs and an LVR, but they don't look at your ability to pay the interest. If you've got the relevant deposit, you can buy the property. So you copy and paste that into New Zealand as a policy, no interest deductions. Then suddenly you have a banker looking at you saying, well, we traditionally took your salary plus 75% of rents, and as long as that is greater than your debt costs and your living costs, we'll lend to you. Now they're saying, well, they must say, well, we've got to impute the cost of the tax into the debt servicing calculation. So on average, if you're losing somewhere between 4 to 7 grand per property, that's going to be about 25% of your rents. So I'm picking that we're going to see banks, for servicing purposes, dropping the amount of rent that they take from 75% to 50%. And that will cause many highly geared investors to fail servicing moving forwards. And that is going to be a shock to the banking system. Okay, so tax is one shock, but when you start shocking the available liquidity, that can really hurt the market. So I have great concerns about this. There on the right screen is something from ANZ talking about rethinking it. A broker spoke to me earlier in the week, as in yesterday, and said that they, ANZ anecdotally, well and truly down this line, and 50% has been discussed, backroom chatter. So, if you consulted with the community about changing these rules, the government would know this, but I doubt they know this. They haven't thought it through. So who does this hit? Well, leveraged investors tend to be middle New Zealand saving for retirement. So the Labour narrative is that these are tricky property speculators enjoying loopholes at the expense of other homeowners. We've got a massive advantage, don't we, apparently. But in my experience, and I have 10,000 tax entities in my accounting practice that we act for, and I meet, tens of thousands of people across the years through my workshops and webinars and so forth. I find, in fact, investors are typically police, nurses, tradies, small business people and professionals. And these are the people that borrow, revitalise houses, supply the housing stock, work to keep their portfolios afloat, and wait 10, 20 years to live off the capital gains that they've accumulated through conducting this very productive business. Actually, these are the people we're attacking here. It's middle New Zealand, because wealthy New Zealand doesn't have debt or carries a lot less debt. So there is no non-deductible interest to have to pay tax on. They're already rich enough that these rules don't apply to them. So it's people that are starting off early stage in their stage of life, or middle stage, who are carrying debt, and these are the people that ironically are being attacked. You would think that they are, middle New Zealand is Labour's base, but actually they're taking their base with us. So wealthy people, boomers, old investors, they will easily segue into the new property economy with ease. They will be able to buy new builds or build new builds. They have the financial horsepower to do it, and they will gain access to better tax advice. They will have the types of asset bases and types of businesses and structures that will easily allow them to repurpose debt, as I was showing you. But poor old middle New Zealand with vanilla portfolios, you won't be able to do it. So this hits middle New Zealand. I've experienced an extraordinary amount of communication in the last few days, outrage from investors. I've had 3 people ring me and ask if we can sue the government, and sue the government for breaking their promise, sue the government for doing something as ridiculous as characterising interest as a loophole enjoyed by property speculators. And the answer is, unfortunately, you can't. You can't sue a government for unpopular, legislation and decisions. My advice to you is that this government will not care. This is the bourgeois outraged. They're chipping into our Chardonnay budget as far as they're concerned. They couldn't care less about our outrage. The only thing they care about is getting re-elected and staying in power so they can keep pushing this stuff through. So unless they see their polls drop, or unless they see that you're going to punish them, they're not going to give us any concessions here. In fact, it's going to get worse. So everybody should be signing petitions now. Everybody should be writing to the government and shouting out your concern. This government do pay attention to the press. We've seen that with the bubble being opened. There's a decision to have a meeting about opening the bubble in 2 weeks after the bad press last week about it. They pay attention to what happens in the media. Ardern, our dear Prime Minister, who I must say I have had great respect for as a leader, she won't talk to Mike Hosking anymore. Made me laugh when I saw her do that last week. He can be a bit rude. But these are the people that are going to save us from this government, because they're shouting out what they're doing and saying we've got to stop it. New Zealand is so apathetic, and we let the government roll across the top of us with a lot of the initiatives, which I'm sure I won't discuss. I don't want to get too wide, but our apathy has got to draw a line here. We have to step up and speak out. Where does all this go? Well, capital gains. I think Treasury told the government to run it at 15 or 20 years, the Brightline rules. And I think the government know that if they jumped to 15 or 20 years, there would be, a huge backlash from that. Not that there's not going to be one for what they've done, but they know that that is a huge step too far. And they're smart. So, we had 2 years, then it was 5 years, now it's 10 years. Guess what's coming? There's a carrot. It's only 10 years, that's fair. Well, guess what? Once we get over the 4-year phase in and that's normalized, it's now 15 years because that's fair. And then it's 20 years because that's fair. So read the writing on the wall here. Investors are going to sell second-hand houses and swap to new builds, aren't they? I'm already heading down that path. I've got a heap of houses. So I look at stuff that's not subject to Brightline rules that I've had for a while, that is going to be affected by the deduction limitation rules and the interest limitation rules. And I'm now looking at cashing that and moving into stuff that is new because there's a huge tax advantage to it. So that's going to tighten supply. I'm not alone in thinking that. Everybody's thinking that. And so as you take secondhand houses away from renters and sell them to homeowners, you put pressure on the rental market. And so next thing is we'll have rents going up. And everybody is raging that we're going to put our rents up. How high can you put your rents up before your tenants simply can't pay? As a landlord, I've got my rents where I can get them to. I can't just go to a tenant and say, the government's cost me $100 a week, I'm putting your rents up $100 a week. They can't afford it. But I think it's inevitable as the market phases in these interest deductions, you will see landlords phasing in rental increases aggressively. So then what? This becomes a problem. Rents skyrocketing because of the greedy oligarchs that own the property portfolios out there. So the government then come in and say, well, we need to put rent controls in because the rest of the world has rent controls and they work over there. The rest of the world doesn't. Some places in the world do. Socialist economies do, And yes, New York has them and they do terrible things in New York. You have people living in houses paying $2 a week for their apartments because that was the price in 1920 for the rent. And lo and behold, they managed to live for 100 years. So now they're paying $2 a week rent. This stuff happens in those sorts of economies. And so you end up with property becoming a basket economy, which causes withdrawal from the market. And so then the government steps in because that's, I think, what their real agenda is, a socialist government to start to provide the supply. And they put rent controls in place and you see a progressive withdrawal from the private sector in that area. New homeowners are not going to be able to compete with investors on new housing stock. So Tony Alexander was all over this today in his newsletter that he sent out, and I was discussing this with him. So all this new cheap housing stock that's coming through, guess who's going to buy that? People with money and deep pockets, property investors. They'll sell their secondhand stock and grab all the new housing because there's a massive tax incentive on it. So what's that doing to first home buyers, new home buyers? It's putting them in a position where they're getting the second-hand stock, the new stock's going, to the investors because of the tax incentive on it. So that's where this goes. And the biggest concern I have is rent controls. The government, through what they're doing, are distorting the market, distorting supply and demand, rather than fixing the problem, increasing supply, changing the RMA, bringing in high-density zoning across the country, putting infrastructure in the ground aggressively. Okay, they've put $2 billion into a fund. I saw what they did with Kiwi Build. They built nothing in 3 years, practically speaking. What are they going to do with infrastructure? It'll take them 3 years to get the councils to talk about what their needs are, let alone putting the money in the ground and creating the sewer pipes and the stormwater pipes and the utilities we need. So I think this is going the wrong direction. Okay, so the best thing you can do is let the government know what you're thinking if you have the same concerns as me, and let them know that it's not acceptable. We don't want to be a socialist economy. Okay, critical thinking. Back on to the positive. You've got 2 years before these interest deductions really start to bite, so don't panic. Nothing changes really next year. You've got a 12.5% reduction of interest deduction. There is no panic. Ask yourself, in addition to that, what is the asset worth in 10 years? And yes, there could be a short-term slowdown and asset values could decline as a result of the plethora of things that are going to happen as a knock-on consequence of this. Yes, asset values could start to decline. And we've seen that before. The GFC, asset values declined. So we go into a downturn. Supply stops if that happens. Everybody backs out and says, oh, we don't want to build at a falling market. Pent-up demand happens. You start to have unsatisfied demand as households start to come in. The government says, what are we going to do? Possibly they reverse some of these policies. More likely they open the doors to immigration. More likely there's a change of government and the new government fixes some of these problems. The asset values recover, and in 10 years' time, hey presto, we get more growth. Probably not as much growth as we've had in the last 10 years because the cost base is getting too high. The growth must slow down. but ask yourself what the asset is worth in 10 years. And that will give you a better answer as to what you're going to do in the next 12 to 24 months. Because dumping the asset may not be the answer. Maybe just pay if you're not that affected by this, just pay the tax. It's not that much, the tax. If you've just got 1 or 2 properties and you can afford the cash flow. So if you have the financial horsepower and the means and the mental space to do it, seek to move to new builds. Cash the old stuff, buy the new stuff, and repurpose debt lawfully. So you can use those mechanisms that I've been showing you tonight. Just make sure you check them with your tax advisors. I've seen manipulations of those that are too aggressive. You've got to be careful in the way you do it and do it lawfully. So take advice. Develop to hold has always been a fantastic place to be because you don't pay GST and income tax on the gains, and you can develop investment appropriate stock. So at the moment I've got 12 little units that I'm having designed to build in Glen Eden on a terraced housing site I've got there. They're 55 metres each, and I think that I'll build them all in for 300 grand each for 12 of them, and they'll rent at $550 per week. So it'll have good cash flow, and there's good capital gain in them. So you apply these rules, they're new build, and even though I've owned the land for a few years, I still expect to get the benefit of the deduction of the deduction for the interest, because they should be exempt. They should count as new builds. So that's a great thing to do, and I've preached that for years, because in years gone past it's been the right thing to do. That's going to be a hot item for investors moving forwards. Which means that development sites are going to become more valuable. Developable sites are going to become more valuable. Second-hand sites that have already had their value extracted out of them, that have no development potential, if you buy them, they get all of the new tax rules applying to them, so they won't quite have that shine that a developable site has. If you can't handle the cash flow implications of what's going on, and we should think about Reserve Bank if they push in, if they withdraw interest-only loans and push everybody onto principal and interest, if that sort of thing starts to come through, then everybody needs to look at their cash flow. So this only gets harder as you get to year 3 and 4, and the 4-year phase-in starts to bite. So if your household can't handle the cash flow, you should be selling now. Don't wait until everybody's getting bitten by the phased-in rules. Get ahead of the curve on it and get out of the second-hand stock, and then go back and get the new stock. Watch out for banks knee-jerk reacting to this. So sometimes banks can overreact to environment changes. I've seen it in the past, and I wouldn't expect modern banks in New Zealand to overreact, because they have in the past, hurt themselves by crashing the market, by being too tough on their customers. So I would hope, and that's what happened during the GFC, they were pretty kind to their customers, most of them, because they realised that if they overreact, they actually shoot themselves in the foot, because they crash the market. But notwithstanding that, you can get people in banks that become very conservative and watch for a change of attitude of banks. I expect them to become quite adverse on property as a result of this. So what can you do to get ahead of that? Well, the sooner you get your lines of credit in place so that you can weather the storm, the better. Don't wait till you need the money or the market's impaired to get a line of credit in place, so that if you need some spare cash, you've got it. So start to think about a rainy day. A bank will give you an umbrella when the sun's shining, so goes the saying, but as soon as it rains, they take it off you. So go get your lines of credit in place and hunker down the hatches, because we might see a tough couple of years out of this. And remember this when you vote in 2023. This government has done this to us. They've broken their promise. They said they wouldn't do it. They've done it, and they've done it in spades. So that is the presentation. I'm now going to answer some questions. Thank you all for listening, and I hope that's a benefit. Anthony, you need to shout, because it's kind of hard to hear you, actually. I think we'll jump down a bit. As a property manager, what advice would you give landlords who feel they should sell because of the cost of this legislation being too much? One landlord reckons he would need to increase his rent by $200 a week, asks Rachel. Well, Rachel, I think it's household by household. You've got to do your own maths. I've looked at mine, and it feels to me like it's sort of $4 to $5 grand a house, and I can handle that as a cash flow, so I'm not going to sell. I think in 10 years' time, most of my properties will be worth more, and I already have my household, all of my debt on principal and interest, most of it. So I'm later stage investor, so it doesn't bite me so hard. So I'm not going to overreact to this. I'll sell a bit of the buy and hold that I think has had all the value extracted from it. That's not subject to Brightline, but I'm not going to sell too much because I think I'll probably regret it later. So, but if somebody can't hack the cash flow, if your household's already sitting on an edge from a cash flow perspective, and these taxes are going to tip you over, well, just consider what a spike in interest rates are going to do to you. Because it used to be that when interest rates go up, that you would get to claim tax on it, so it would take the sting out of it. If interest rates went up 1%, you got to claim 0.33 back. Well, now you get the full whack of it. So these rules are going to hurt. So it's household by household. If you can't afford to pay the cash flow implications of it, then sell earlier, not later. But don't overreact. Is a new build exempt from new interest deductions forever? Well, that is the indicative. Position from the government. So it's not just the next 4 years, it's 100% deductibility forever is what the government have promised. But we know what their promises are like, don't we? Not very good. So I hope that answers your question. They've said it's a permanent deduction and business as usual for new builds, which is why everybody will be moving towards them. Revolving credit interest deductibility, well, it's just subject to, it's not a matter of what the nature of the credit facility is, it's a matter of what you do with the debt. So if the debt is being used for residential property investment deriving residential rents, then it's non-deductible. What would new build be exempt? Would a new build be exempt from interest deductions? We've answered that. Question 1, what is a new build? We've answered that. A new build is a property is yet to be determined, but is most likely 12 months, probably acquired 12 months from CCC being issued. And then this person goes on to ask about what if it's in individuals' names or companies' names. These rules do not distinguish between entity type. These rules are entity neutral. And families join together and buy a big section. They build 3 more houses. The idea is to distribute the properties equally. Will this be considered new builds? If you're building new houses, yeah, they'll be new builds. So you'll get the exemptions on those. How would a property manager make the change in a day? Is that legal? Okay, so Lucy, you're not making the, I'm not sure what you mean by PM. I think you're saying, how do you move the asset in a day? As Anthony popped in and said, you don't have to move the asset in a day. You just need to get a binding agreement. And
that might have been a disgruntled member of the electorate.
You're hard to hear, just speak a bit.
Yeah, that might have been a disgruntled member of the electorate asking how the Prime Minister is able to make such a significant change
Lucy,
at 9 o'clock on a Tuesday and have it effective by the Saturday, perhaps.
Yeah, I wish you could be heard better, Anthony, but I'll repeat it. Lucy, you're saying, how can the Prime Minister make a change in a day? Is that legal? Goodness. Anthony, are you seeing my screen of questions or are you seeing the main screen?
Main screen.
Oh, yeah, okay, cool. If we do a development on a site and that site has already passed the Brightline period, will we tax one of the new Brightline rules? No, it goes from when you originally purchased the property, so that's good. Matthew, is residential property investment still a good idea with this new law? Well, it's business as usual for new builds, Coke, and you're still getting the benefit of leverage on capital gains, but we are going to see, tough times, I think, particularly in the next 6 months. So, long run, yes. Short run, it's going to be wind against us. What are the chances of that the government will backtrack on this interest deductibility rule before it's passed into law? Jay, I don't know. I mean, we need to really go back hard on this. Did everybody see that there's a petition going around? It's on Change.org. If you jump on Change.org, you'll be able to find the interest deduction petition. I'm sure you'll see it on the various property investor threads online at the moment. And make sure you sign that. It's floating around at the moment. There's a petition. Change.org regarding reversing interest deductibility. So Jay, I don't know. There's no way they want to do it. They certainly have no respect for property investors. I think the only reason they'll do it is if they know that it's guaranteed they're going to get chucked out for doing this. So we've got to tell them that. I did have a question. We currently own a house in Auckland, which is rented out, but you rent in Nelson. So you rent in Nelson, you rent your house out. Are we impacted by this interest not being deducted, and does this affect our working for families? So you've got a property, it's a residential property, I presume you've got debt on it, so it's acquired prior to March the 27th, so you get phased in interest deductions over the next 4 years, ending up with no interest deduction, so yes, you're affected, and then that will flow through to your tax return, which will ultimately need to be resolved, because you're right, if you suddenly have a higher tax position, does that mean that spouses for matrimonial purposes can claim more money off you, or working for family tax credits reduced because you're deemed to earn more income? All excellent thoughts that are yet to be determined. So good question, Alicia. Hi, and thanks. Approximately how long is this webinar? Oh, till it ends. And yes, you can view it later. I'm going to send it to you. The main presentation is done, so if you need to go, just hang up. I asked via email, but putting it here, is interest deductible, are interest deductions still allowed for a flatmate situation? Currently, these losses are not ring-fenced, so I assume new rules wouldn't capture the same. Anthony, do you want to talk to that for Jeff?
Well, so the other situation is that somebody...
Oh, we can't hear you, Anthony. Anthony, why don't you come into my office and answer the questions in here, because then they'll be able to hear you. So we'll come back to that. Would like to know if you have ring-fenced losses still available this year. Can you still use them to offset rental income? Yeah, we think you can. So that's a good one, Jenny. We think your ring-fenced losses will carry forward, be available to offset these obligations. Does the addition of an owner to a property, for example, a mum house, does addition of an owner to a property, e.g. the mum, and the house is adding a son to the owner, also trigger a reset for Brightline? Oh, yeah. So, Joshua, I presume that for banking purposes, you're putting your mum and your son on the financing. And so your question is, what are the tax consequences of that? And if it's your family home, I don't think there's any consequence, because you're just spreading the ownership of your family home around. But if you are selling an investment property, effectively disposing of it to your relatives, then you are triggering disposal consequences, which means new Brightline rules. And if an existing investment property is subject to Brightline, then putting the names on the title can in fact trigger a disposal for tax purposes. Yep. So can we download a copy of these slides? No, but you can watch them, Mike. Any question or any changes to chattel valuations? None that I'm aware of. So they will help. Can you move residential lending across to commercial property in your accounts to make the interest deductible? Ben, you have to do it properly. You have to actually refinance it to repurpose it. So there's quite an undertaking there, and that's something that your accountant should be able to help you with, or GRA can help you with. Yeah, but you have to do it properly. There's a lot of paperwork to do for it. I have a signed sale and purchase agreement for an off-the-plan apartment due to settle in 12 months. How will this tax affect me? So I think, Jason, we've answered that question tonight. You know, you've got a new build acquired prior to March 27. You've got a binding agreement. Hopefully that will meet the definition of a new build, so no impact on you. You'll get full exemption under new rules. That would be my expectation, but it's subject to the rules being clarified. Is there any difference for new loans taken to remediate an existing property brought over 10 years ago? Yeah, so the new debt incurred after March 27th is just non-deductible, isn't it?
Correct.
Yeah,
non-deductible.
That's correct. The interest on non-deductible properties for short-term rental like Airbnb, holiday houses, and bed and breakfast. So under loss ring fencing rules, there was a distinction between residential and commercial property, and there was some grey area on whether Airbnb or holiday homes or bed and breakfasts were in fact commercial use. And the government has, in the draft rules, talked about the definition of a residential property, and they describe it as a dwelling capable of
a dwelling configured for residential purposes.
I don't know if I can hear you. A dwelling configured for residential purposes.
Yeah.
So that they've clarified in short that Airbnb, holiday houses, and B&Bs are residential.
Yeah, a bed and breakfast may be often a bed and breakfast. People live there, so there could be home aspect to that, and that could also be more likely to be a business. So there's some potential there. But certainly a home rented out to short-term stay occupants, it's caught by ring fencing, and I believe it'll be caught by these new interest denial rules.
Excellent. Okay, so some hope for the B&B, the holiday houses, and the Airbnb, no hope. When a property is no longer considered a new build, when you sell it to somebody and the code of compliance is beyond 12 months of age, would be what we expect to be the definition of a property that's no longer a new build. So you might build it new or buy it new, you sell it to someone else that's now secondhand in such circumstances. Are there any structure, and all of this is subject to clarification because we're still consulting. Are there any structures that will exempt from the interest rate changes? No. This is entity neutral. All you can look at is repurposing interest over business assets or commercial property. In the UK, it only applies to houses owned in your own name. So investors are now buying companies to get the statutory deductions in companies. And we looked at that, and my understanding is that these rules override our statutory deductions in companies.
Well, we certainly would expect them to. They'll be rather toothless if they didn't. So yeah, I'm sure that once we see draft legislation, the statutory deduction, which does currently apply to companies, will be wheeled back.
Yeah. So Stephanie, we expect the statutory deduction for companies to be rolled back. But the devil will be in the details, right? It's a lot to go there. What is your prediction to the market for this year and next year? Well, I think it's going to be soft. This has to be a terrible spread for the market, and this coupled with healthy homes, coupled with Brightline, with the deduction limitations, LVR restrictions, everything is being chucked at investors, and this must absolutely slow the market. Having said that, there is still a lot of demand for home ownership, so homeowners are still going to buy houses, and there's I think going to be revitalized demand for new builds. There already was good demand for it, but it's pretty much business as usual for new builds under these rules. So it wouldn't surprise me to see new builds having quite a healthy continued demand. Is there a recording? Yes, we recorded it. We'll send it out. Is the treatment for interest deductions the same as for long-term rentals and Airbnb? We answered that. So Airbnb are caught as residential properties by definition. What happens if a partnership owns a property and is one of the partner's main home? Is the other partner taxed? Good question. What's your thought on that, Anthony?
Well, my thought on that is that it's not the partner's main home. So if Matthew, if you and I own a property together and I live in there and we sell the property, I get the main home exemption for the half of the gain that belongs to me.
Yes.
But you don't get the main home exemption for half of the gain that belongs to you.
Okay. So I hope you caught that. 50% of the gain would be taxable to the person that's not living in the home. I borrowed about 20% of the final value of a property I purchased in the last month for renovations. How will this be assessed? Well, if you've drawn it down prior to March 2027, you're fine. So I would draw the debt down tomorrow if I was you. Anthony's got the IRD release next to us, so you can read that while I move to the next question. Yeah, we'll come back to you in 1 second. How about you're building a rental property on the back of your home? Is it a new build? Yes. We would expect it would be. So subject to consultation, yes, we think that would be. Bought a property on the 10th of March and the settlement date is the 31st of March. Can you still claim interest? Yeah, you get 4-year phase-in interest deductions and 5-year Brightline rules. Shall we start selling second-hand residential property and look at investing in new builds? Yeah, I think that's a good idea. It doesn't mean you dump all your existing resi, but look at whether there's a reason to keep it. If you don't have to sell it, then start buying new builds. Question for the end, if you don't cover this, what constitutes a new house that can sit under the 5-year Brightline rules? Okay, we covered that. Airbnb, we covered that. If I can't afford to keep my rental property, when in the next 2 years is the right time to sell? Okay, Kevin, who the hell knows? No one knows, but my guess would be now would be a good time to sell it if you're not subject to Brightline rules, because it takes the market a long time to work this stuff out. Everybody in this workshop is an early adopter and paying attention. There are tens of thousands of people asleep at the wheel, still think the property boom is on. There's a number of economists that would meet that category, I think, including the Westpac economist saying yesterday that, or earlier in the week, that 60% LVRs won't make any difference to the market. I think he's on a different planet. So these people that are asleep at the wheel, they'll still buy your house at full value. So if you don't sell it in the next couple of months, then the market will start to become more aware of the downturn. Asset values will soften. I still think you'll be able to sell if you've got a good property, but it'll take a couple of years for a good market to come back. That would be my expectation. Doesn't mean you're not an investor. You can still make good money as an investor and great money as a trader. If the market comes down 10%, then the whole model just shifts down 10%. You buy 10% cheaper, renovate and sell 10% cheaper. You're still making money. So the world has not ended here. It just means that we might see a downturn for a while before we see another upturn. With petitions going around, a lot of feedback from various groups regarding interest deductibility changes, do you think Labor might be pressured to reconsider their position? Well, I certainly hope so. And I encourage you to get stuck into yelling and screaming and letting them know that we're not happy. Hi there, Amanda from Wellington. Hello, Amanda. And now, should an owner work out how much the increase in, should an owner work out how much to increase their rent by? Because of course their income, will increase, so their tax will increase at the same time. Double-edged sword. Yes, interesting. So your income increases on paper.
Taxable income.
Taxable income increases, but your real income has not increased, has it? Because you've paid 30 grand of interest. You don't have any cash, but now you have to pay 10 grand of tax as well. So your taxable income went up 30 and your cash flow went down 10. So I don't, if that's the nature of your question, yeah, you're going to earn more, which you'll pay tax on, but actually you'll receive less. So it is a double-edged sword. It's terrible. New builds, we've discussed that. How do banks assess serviceability with the new interest deductibility rules coming in? Good question, Joshua. I've answered that. Paul says, what's considered a new build? We've done that. I'm hearing that 3.8 billion for local authorities and developers is coming. What do you think the figure needs to be? No idea, but that's a damn good start, isn't it? If they start putting pipe and services in the ground, that's part of the supply solution, and you've got to get behind that. That's a great idea. As long as it actually turns into pipe in the ground and doesn't turn into, other things. Right, so more questions. Interest deductibility for first home buyers not been proposed to level them with investors. Oh, that's a good idea. So you're saying give interest deductibility to home buyers like the USA and Holland, rather than taking interest deductibility off investors. Minimal cost to the government and doesn't annoy anybody. Jay, great idea. Much better idea. But hey, property speculators don't deserve that much respect, do they? So I can't see this government coming up with something positive and constructive like that. Will National Enact change the tax law back? Asks Kevin. We would hope they would, that's for sure. And I tell you, they'll be able to buy a few votes by saying they will. So I expect they say they will roll us back. I'm currently looking at converting existing properties into multiple units. Are these considered new houses? Andy, I think we've covered that. We don't know the specific definitions of new builds, but new CCCs for new dwellings. I imagine the incremental dwellings you create would count in some way as new builds, but we'll wait for the detail. Will ring-fenced losses be dissolved? Will the ring-fenced loss scheme be dissolved now? Will losses already built up from ring-fencing be allowed to be used and offset against these interest deduction limitations? Anthony, my thought on that was you will be able to use ring-fenced losses to offset future taxable income resulting from interest deduction being.
I would expect so, yeah. I would expect so.
Anthony agrees. So, and do you think that the loss ring fencing regime will be dissolved? I don't think it will. No. So we think it'll stay. And there's certainly no talk of it being dissolved. Hi, Matthew, I have a property in a trust. We're planning on subdividing in 2026 to 2027 when the covenants expire. Would I be better selling the section on their own or build new houses on each section? Would I be paying tax if I sell them straight away? Pretty deep question, probably better one-to-one. But you get a exemption under current income tax law for building houses to rent them out. So you're going to get a double benefit, as I said earlier. If you build to hold, you're creating new supply, you get interest deductions, and Brightline rules are not going to affect you. So if you sell, you've conducted a business activity there, so you've the business enterprises, you've added value to your land for the intention of resale, and that's going to trigger tax. For the specifics of that discussion and how the specific taxing provisions work, it's better you come in and chat to us one-to-one. What is classified as a new build? Okay, we've done that. So we're up to 6:48 people. This is 3 minutes of questions. Are traders impacted by the new interest deduction rules? No, you still get interest deductibility. When will we know if the proposed changes are finalised into law? I'd say the next 3 or 4 months. Will transferring properties to LLCs, I think you mean LTCs, overcome those that have to sell to avoid the tax at your highest income tax rate? I think you're saying, so if you move to an LTC, the disposal to the LTC is a disposal for tax purposes, so you pay tax on that disposal if you make a gain. And then later, when you sell it again within 10 years, you pay tax again. LTCs pay tax at the shareholders' marginal tax rate. So if it's a trust, you get the trust tax rate or the beneficiaries. And if it's an individual, you'll get the individual's marginal rates. So if you are thinking that you might make a big gain within 10 years, but you haven't made one now, then you're probably thinking a company owned by a trust would be more tax efficient than an ordinary company, which will pay tax at 28%. And then your final impost tax when you distribute the dividend to the trust will be 33%. Whereas if you hold the shares in your name, it could be exposed to the 39% tax bracket, depending on how big the gain is. Obviously, a very generalised question, very generalised answer. I hope that helps. Does assignment of a sale and purchase agreement to a different entity reset the required date for interest deduction purposes? An assignment of an interest in land, that would be if that binding agreement for the assignment occurred before March 27th, I think you're okay. But an assignment after March 27th is a new agreement. After March 27, you would defeat your interest deductions. So you need to get that assignment done by tomorrow. James. Any way to incorporate a LTD company like it works in the UK? I think we just discussed that regarding interest relief. Would be great if you could. We think that they'll be onto that, but we'll wait and see. The devil be in the detail. I'd like to know how much would the rent need to be increased by in percentage to offset the new rule of non-interest deductibility. Well, here's how to calculate that. Get your interest bill, whatever it is, annually. Take 33% of that, and that's the tax you're going to have to pay. And then divide that. So if you've got $30,000 worth of interest, the tax you're going to have to pay is 10 grand. And if you've got 2 properties, that's 5 grand a property. So that's $100 a week per property. So I don't know if there's a set percentage. It'll be variable by property, but you know, I would imagine that'll be about 15 to 20% of the current rents. But Ivor, I don't think you can just holus bolus increase rents. Your tenants can't afford it. I just don't think that the market's going to be able to do that. Next 4 years, as the rules get phased in, maybe you can chip them up $10, $15 a year. Time will tell. How about buy a rental? How about buy a rent for room, and then add 1 more room to become a boarding house, so that the interest can be deducted? Tom, I think you can do that if you've got 6 or more, and you convert the property to be commercial. But remember, to be a boarding house, you've got to qualify with fire rating and boarding house rules, and you get a different contractual relationship from a tenancy perspective with your tenants. So you've got to go through the legalities of all of that, including the cost of converting the boarding house so that it's compliant. A property manager will be able to advise you on, you know, just what's required. I know I've got a boarding house, and we had to do fire rating with fire engineers, and there was quite a lot involved in a 9-bedroom boarding house. If you have 2 separate houses on one title and you live in one and rent the other one out, where do you stand in terms of Brightline? Well, presumably you already own the property, so you will be under old Brightline rules, which will be 2 or 5 years, or possibly past. So you've got 2 separate houses on one title. Brightline implication of that, Anthony?
Oh, good question. So I would say it's about the main use of the land. So if most of the land, if say the dwelling that they live in comprised or took up the majority of the land, then I think when they sell that one property, they're arguably selling their main home. And if they own it, as you say, the current rules apply. And they say, have you used most of the land for most of the time as your main home?
Right, so current rules say, have you used most of the land, more than 50%, for most of the time? And if so, then you'd get the exemption.
Yeah, I think you've got an argument for the exemption.
For that, that's for property acquired prior to March 27. After March 27, it's got to be all the time, doesn't it?
Yes.
And so then you'd get some sort of mixed use pro-ratering
Yeah, it's an interesting one. So that would be one that would have to have a look at the detail on.
Yeah, the devil will be in the details. So your second part of your question about how that's going to be taxed after March 27, we'll have to see some more legislation, or some legislation, some consultation even would be nice. There's been no consultation, so we can't answer that. One of our rentals is getting near the end of its useful life, and if we were to have it demolished and replace it with a new build, would the interest become deductible on the new build, and would it be fully tax deductible? It is one of two. You want to create a two property on one title. So you want to put two rental properties on one title. So we don't have enough information to authoritatively answer that, but I think logically you'd say, well, you've got one new dwelling with a new CCC. Does that meet the definition of new supply? Well, you haven't actually. If you've got one property there and you've created two, I think you've created a second dwelling. So there could be some pro-ratering, and so you might get 50%. It'll be something like that. We can't tell you because the rules aren't there yet. Going forward, do you think there's any benefit in holding rental property in a company or a family trust versus holding the property in your own name? That's a very good question, Bridget. Bridget. So that is person specific, but what all of the tax community need to think about is that where investment property might have been tax negative in the past or near tax neutral, it's now all going to be very tax positive. So for me, you're either going to want to be in an ordinary company at 28% if the owners of the assets are retired or late stage and both working. So wealthy and or both working. You probably want to be in a company because you want to park your income at 28%. However, if you've got a spouse at home that's not working or children that you could possibly allocate income to through a trust, with the minor beneficiary rules, children who are 16 or older can have income allocations made to them, then the type of structure you'd be thinking about would be an LTC owned by a trust or a trust, that sort of thing. So the advice needs to be tailored to you, and that's the sort of thing we'd sit down one-to-one with you, or you could do it with your accountant. What is your view of new builds apartments in the city? Compare that to new builds in residential areas. Another night. I mean, both are good, valid investments. Keen to be considering build to rent. If you buy a house with an older person, remove and then build. Oh, I'm sorry, it's an older property. Remove and then build a new one. For example, 5 townhouses. And 5-year Brightline rules may apply. When is it considered, and what would the rental deduction implications be? Oh, okay, so it's a difficult one to read out, that one. So I think you're saying, what rules do you get for a property? And I think we've answered that earlier on with multiple examples. So I live in Auckland and the family home is in a trust. I plan to sell the home and move into our rental, which is in a different trust, and we've had it for 6 years. It is old and we plan to bowl the house and build a new one. Should we change our plan? So your existing family home is exempt from everything, so you can sell that, that's fine. And then you want to move into your rental property. When you move into a rental property, you trigger depreciation recovery for any depreciation claims and deemed disposal for Brightline, isn't it?
No. You'd have to sell it to trigger Brightline. So okay. No, moving into it won't trigger Brightline.
Okay, so moving in, no Brightline trigger. Of course, there's no disposal. So there's no deemed disposal from one use to the other.
No, not other than the depreciation you said.
Okay, so deemed disposal for depreciation, no deemed disposal for Brightline because you haven't sold the title. So you can move into that property in that different trust, which you've also said you've held for 6 years. So that's pretty Brightline anyway. So I think your plan's good, carry on. Is this a national party event, asks Jordan. I'd say so, to be honest. So I'd say, yep. Is it possible, actually, it's also an ACT party event, I think, as well. Is it possible to claim my time for managing my properties as a letting fee? Trying to think of a way to legally reduce my tax bills further. Is it possible to claim my time? No. Stephanie, if you claim your time for letting your property, that is taxable income to you. You get a deduction on one side and taxable income on the other. Two quick questions. Question one, I'm unclear whether the announced Labor government are out for discussion, or are there more, or is this more or less a done deal? Thoughts? I think that in their mind, this is a done deal, and the only thing that they're looking to do is to finalise the points and make sure that they haven't left any money on the table for property speculators, would be my guess. Question two, one would assume that National would revoke the changes in 2 years' time. Presupposing that National get in 2 years' time, I would agree that that would be something that they'd look at doing, but we have to wait for Judith Collins to tell us. If I'm building a minor dwelling next to my house on my section, I'm not subdividing because it's single house zone, and I put a tenant in the minor dwelling for a few years, will I get taxed if I sell my house and minor dwelling within 10 years? All right, well, Anthony, you can dig into that one.
Well, for a start, they already own the property, so they're not going to be subject to 10-year Brightline on that property.
Yeah.
So they already own it.
Yep. No
so
Brightline.
They're living there right now.
No Brightline. You own it now, so 10 years later, the Brightline rules have expired.
Yeah. They're not subdividing. They're building minor dwelling to generate additional rental income. I can't see that any out of those facts alone, I can't see that there would be any tax consequences on sale.
So Hannon, we don't see any tax consequences on sale. Brightline doesn't apply. In terms of interest deductibility, I think they get 4-year phase-in interest deductibility if they built it pre-March 27, after March 27.
Well, it's the classic case of, is that a new build, and we don't know the answer.
Yeah, so is that minor dwelling a new build? We don't know the answer. We would hope it is, in which case you could get permanent interest deductions on the minor dwelling. So that's an interesting question. I'm guessing you own an investment property too. I do, 60 of them. Joshua says, for an owner occupied property, which has had a period of renting during 10 years, how's the capital gain during this period determined? How do the government even know if the owner occupier, if it's not owner occupied during this period? Asks Joshua. Right. Well, we have a compliance system in New Zealand where you, basically tell the truth, and if you get caught, you face the penalties regime if you're not telling the truth. So, in truth, the government don't know, but if they catch you, they will charge you with tax evasion or tax avoidance penalties. So it pays to tell the truth, and there are legitimate ways to get around these rules. So use the legitimate ways. Don't hide from the government would be my advice. So turning to the question, an owner-occupier property is renting it out during a period of time. So they're moving in and moving out. So you're not selling the property, so therefore you're not triggering Brightline, but you are, in terms of interest deduction rules, you'll be taxed as to whether you've owned it before March 27th or not. So I would think that's the answer. Your interest deduction rules are based around when you bought the property, and the Brightline rules don't apply because you're not selling it. So as you move out of it, the rents become assessable income, the OPEX become deductible. As you move back into it, the OPEX become non-deductible and you don't receive rent. What is your trading strategy of retaining second-hand residential property but covering the cost to be able to claim loan interest costs and tax on profit? What is your trading strategy of retaining second-hand housing? Well, you can't buy a property with the intention of resale and then keep it and claim the interest. There is no strategy to do that. What you can do is buy a property with the intention of renting it out long term and develop to rent it out long term. So create new supply, and then you get your interest deductible. But if your strategy is trading, that is an intention of resale. And
yeah, of course, if you are a developer or dealer, it would appear that you will get interest deductions. I don't know if they're referring to that.
Oh, right. Okay. Yeah. So if the question is, if you're a dealer or developer, do you get interest deductions? Those are exempt. Yeah. So you get the interest deductions. Somebody says, when is this recording available? Probably a couple of days. Long-term rental property is sold. Can interest deductions be claimed if the property is sold and falls under the Brightline test? Excellent question, and we don't know. We're waiting to find it out. Do you know any courses or books about property development in New Zealand? So I have a course called Property School, and Night 6 covers property development in New Zealand. Check it out on our website, gra.co.nz. Property School is a 7-week course. The commentary from the government around interest deductions in relation to new builds remains unclear. Do you expect new builds to be completely exempt from interest deduction changes? Okay, so I think these questions are now becoming repetitious, so probably we'll just leave it there. On behalf of GRA, thanks everybody for listening, and thanks Anthony Lipscombe for staying and presenting to the group with me. These are changing times, and I repeat my request to you, let the government know we're not happy as a community. If you would like help with what you're doing, be it selecting your path and property in the future, or be it in the tax arena, getting assistance with your tax affairs, jump on our website, gra.co.nz, come and talk to us. We help people all the time with all of this stuff. It's what we do, and we're very good at it. Thanks everybody. I think I'll leave it there, and thanks Anthony. All the best with these new rules. I will run another workshop later in the year once we get clarification, so stay tuned for that. Thanks and good night.